Maybe you've seen the news recently. Jerome Powell of the Federal Reserve just cut interest rates another 25 basis points. You would think that this would be a good thing for the economy, but the stock market dropped 1,100 points. Why is the stock market dropping when the federal funds rate or interest rates are going down? This is a big question that we need to know the answers to. If you get value out of this video, please give it a like and subscribe. Thank you so much. Yesterday, the stock market went down for the 10th day in a row. This was the longest downward trend in the Dow Jones since 1974. Long time. And as soon as the Federal Reserve Chairman, Jerome Powell, announced that they were going to be lowering rates by 25 basis points, he followed up with this one interesting line. He said that he anticipated that there were only going to be 2 more rate cuts next year. Now, this is not what the market was anticipating. Everyone thought that there was going to be multiple rate cuts next year and that the cost of borrowing, which affects purchasing of new homes, it affects commercial real estate, it affects corporate debt, the cost of borrowing was going to go down. We were going to get back to normal. Everything was going to be hunky-dory again. Well, when he said these words, all of a sudden the stock market started realizing, holy cow, this inflation problem that we've been dealing with might be a little stickier than we initially thought. By the way, before you leave, at the end of this video, I'm going to give you a secret weapon that Warren Buffett uses to determine if we are in a bubble or not. You're going to want to stay tuned. The reason why Jerome Powell is potentially only going to cut rates 2 times in 2025 is because inflation is ticking back upwards. And when you lower the federal funds rate, what ends up happening is inflation goes up. So they can't lower it too much. What does this mean practically for our economy? It means we may be going into a season of stagflation. It's the growth of the economy is stagnant, but inflation is persistent. This is really, really bad. But there's one more secret that I've got to get over into your hands. There's something called the Buffett indicator. You guys know Warren Buffett. He's considered the greatest investor of all time. Well, what is this Buffett indicator? What is this secret weapon to know if we're headed for a drop in the stock market, if we're headed for a drop in the economy, or if we should be buying because we're headed for some good times? The Buffett indicator, aka Buffett index or Buffett ratio, is the ratio of the total United States stock market to GDP. The Buffett indicator equals total US stock market value divided by gross domestic product, or GDP. As of September 30th in 2024, the ratio values are as follows. The total US stock market value is 60 trillion, and the annualized GDP is about 29 trillion. That equals 208%. This ratio fluctuates over time since the value of the stock market can be very volatile, but GDP tends to grow much more predictably. The current ratio of 208% is approximately 66%, or about 2.2 standard deviations above the historical trend line, suggesting that the stock market is strongly overvalued relative to GDP. Why does this matter? The Buffett indicator expresses the value of the US stock market in terms of the size of the US economy. If the stock market value is growing much faster than the actual economy, then it may be in a bubble. Similar to the Buffett indicator, the Wilshire 5000, a market cap weighted index, tracks all US publicly traded companies, which includes more than 3,000 firms. The higher the ratio, the more overvalued the market is deemed to be. Data from long-term trends reveals that the current Wilshire 5000 to GDP ratio stands at also approximately 208%, surpassing levels seen prior to both the dot-com bubble and the global financial crisis. For context, during the height of the internet stock frenzy in 2000, the Buffett indicator reached over 140%. In 2007, just before the subprime mortgage crisis disrupted global markets, the ratio was around 110%. Today, we're looking at 208%. What's the point? Warren Buffett has this little metric that points to if we're in a bubble. And I'm afraid to say We are in a bubble right now, and inflation is not going to help. Lowering interest rates slower than expected is not going to help. The 10-year treasury ticking upwards. In the last day or so, it's gone parabolic, 4.5%. That affects lending. That means that it's actually more expensive to get loans. What's the point? The point is, guys, what we saw yesterday, as of the time of this video, what we saw yesterday, I'm afraid to say, might be a foreshadowing of what is coming in 2025. So the question then becomes, are you prepared? There's a time to play offense, there's a time to play defense. Typically, you want to play offense 75% of the time, but we may be going into a season to play defense. If you got value out of this video, give it a share, give it a like. We'll see you next time.